In this tutorial, I'll be going through with you MXIM symbol. I'll just copy this and paste it in Google and write stock beside it. You can see from Google the stock is Maximum Integrated, and you can see from here as well. The information on the left hand side is from Google, and the information on the right hand side is from Wikipedia, as you can see. If I want to buy the stock right now, I can buy it from 60.2 US dollars. That's the price per stock. And if I want to know when was this founded, I can just see here from Wikipedia. It doesn't show outside. I'll just click inside the Wikipedia and I can see the box here. That's very important. It says founded 1983, 36 years ago. So I need to know when was it founded. You can also see the industry, which is semiconductors. And I just want to show you one website, which is macro trend, and I've just left the link in the description of the video. And you just go to price ratios and then price book ratio and type in or paste in this symbol and make sure that the name besides it is same. And I'll explain briefly for people who are new and who are not sure about price book ratio. It's just loading. Okay. So what is price book ratio? The book value is the real worth of the stock, and the stock price is the market price. If the book value is $1 and the stock price is $2, that means that you're buying something for $2 that is only $1 worth. So you're buying something that is expensive. So make sure that the price book ratio, if it's less than one, that means that you are getting a stock at discount and it's very undervalued and it's ideal time to buy. If it's one, that means that you're buying the stock the same worth, so it's not expensive or cheap, so which is good as well. If it's more than one, that means that you're buying an expensive stock, so you're paying more than what you should be paying for. And the higher the number goes, the more expensive it gets. Right now, it's 9.87. It means that the stock is right now 9.87 times more expensive than it should be, than its real worth. So it's a lot more expensive, and that it has been. If I have the data from 2006 up till now, and right now it's the most expensive, you know. And if I see in 2017, it was 5.58 times more expensive. And the lowest it was, I think, in 2008 when it was 0.89, which means that it was lower than one ratio, and this means that you can get the stock at discount and it was undervalued. So this was ideal time to buy the stock because it's you can get it cheap. And if you look vertically above, you can see that the book value or the real worth of the stock is $9, and but you can get it from the market for $8. So you were getting something $1 cheaper. So in 2008 December, people who bought the stock, they bought stock very cheap. It was undervalued, and so it was very better to buy that time. But right now it's 9.87 times more expensive. Let's see the other ratios. Right now I'm seeing the current ratio. The current ratio is that if the assets are more than liabilities, if the ratio is less than 1, that means that it's danger, it's risky stock because the liabilities are more than assets. If it's 1, that means assets are equal to liabilities, which is good, but there's no margin of safety. We are looking for to invest in a stock that is not risky, that has a margin of safety. So we will be looking at a ratio of 1.5 or more than that. So right now it's 6.46, which means that assets are a lot more than liabilities. And you can also see it's vertically up for your own self, that it's zero point 0.4 is the liabilities and 2.58 is assets, which means 6.46 is a lot more than 1.5. Let's have a look at the previous periods as well. If the stock has ever been below 1.5, no, it has never been. So since 2005 up till now, the stock has always been above 1.5, which is brilliant because there's a lot of margin of safety. Let's look at debt equity ratio. In debt equity ratio, we know that if the company is mainly operating on long term debt or on equity, if the ratio is zero point 0.5 or less than that, that means that the company has very good margin of safety. If the ratio is more than zero point 0.5, then it doesn't have a good margin of safety, it's a risky stock. So we are looking at only zero point 0.5 or less than that for it to be a very secure and have a margin of safety. Let's have a look. Okay, so we have it right now, 2019 March data, and it's zero point 0.6, which is above zero point 0.5. So it's not very good. We need zero point 0.5 or less than that. Let's have a look previously, 0.56, which is above zero point 0.5. And in 2017 December, it was zero point 0.5 exactly, which is good. But let's see previous 0.68, so it's been fluctuating. But if we notice that we have data since 2005, since 2005 up till 2017 March, it has never been above zero point 0.5, which is brilliant, which means the stock has been always secure. So point it has always been less than zero point 0.5, which is brilliant. But after March 2017, in June 2017, it is 0.68, so it's above zero point 0.5, and it remained that, and then it came down in December 2017, and then again it's going up, and right now it's zero point 0.6. So now the stock has become risky. It doesn't have a good margin of safety that we're looking for. So from 2017 June, it started to become risky. So we need to be careful about that. But even if it's zero point 0.6, it's still less than 1. The ratio is less than 1, which means that it's still operating more on equity. If you just look vertically, equity is always more than long term debt, but still we are looking for it to be less risky. So we need a ratio of zero point 0.5 or less than that. So, you need to make a decision. And if we could look at return on equity, we are looking for ideally 8% or more than that, and for it to have good margin of safety, so that we can rely on it. So let's have a look. Okay, so we're looking at 8% or more than that. So right now it's 36% in March, which is brilliant. It's a lot more than 8%. And let's look at the previous ones as well. So okay, so for just once in a while in December 2015, it's less than 8%. And then in September 2015, it's 1.53%. So it's like two times, twice, but still there's a return, a positive return. There's no negative return, which is a good thing. But we are looking at 8%. So, it's just if it's a once in a while or that's, I can just ignore that. That's fine. And let's have a look at the previous one. So it's going brilliant. And again in 2010 September, it's 2010 June, it's again less than 8%. And it has been a minus in 2009 September. So there are fluctuations, but mainly over the period, mainly it has always been above 8%. So it's up to you to make this decision. Let's have a look if this stock pays any dividends. I'll just copy that, paste that in Google, and I'll write stock besides it. And I can see the dividend yield is 3.06%, which means the dividend yield suggests that the firm has enough money, or it's generating enough money that it can pay off its bills, its costs, its creditors and loans and everything. It can pay off that, and still it has money left, which is extra money, which it gives to shareholders. So a firm that gives dividend, that means that they are doing, it reflects that they are doing very good financially. So which is a very positive sign. So it does give dividends. Let's have a look what the employees have to say about this who are working here. Let's copy that, and I'll just type in reviews and indeed what employees have to say. That I'll just click in here, and I can see there are 340 reviews, which are quite a lot of reviews, and it's 3.6 stars, which is brilliant. It's above average. So for 340 people think it's 3.6 stars, which is brilliant. And you can just read through it as well if you want. And I'll see that in Glassdoor as well, what it has to say. And if I just click there, I can see that we have 839 reviews, which is quite a lot, and it gives 3.4 stars, which is brilliant. It's like average. And we have the reviews are 839 people are giving 3.4 stars. This is brilliant. Let's see if it has any patents. um, I use Justia patents. I've just left the link as well in the description, so you don't have to worry. And let's see, so what I'm looking for is applicant and assignee. I'm not looking at inventors, because inventors are people who invented the patent, but they don't have the full rights. Only applicant and the assignee has the full rights. So if I see that in 2012 they have a patent, 2012 again, November, October 2012, 2013, and so on, you can just go through the patents. And I'm also interested that they have, if they have recent patents in 15, 16, 17, 18, because recent patents mean that they are still innovating, they still have a competitive edge. And patents reflect that a firm is strong, it has a moat, and it can thrive very well in competition. And so the more patents a firm have, the better. So you need to just go through the list. It's a long list, so you can just have a look. So which is a very brilliant thing that they have patents. It's a positive thing. And let's see, I want to see the key executives of this firm. I'll use Yahoo Finance, and I'll just type in there, and this one, and make sure the symbol matches the name of the company as well. I'll go to profile, and you can see the sector technology and industry semiconductors. These are the full-time employees. And brilliant, they have key executives, 5 key executives that are main people of the firm, and all of them have their salaries shown, which means the more transparent the firm is, the more information it gives, the better it is. It's more trustable, and the better it is. So they have shown all the salaries of all the key executives, which is brilliant sign. And you can just go through it as well. And I'll just see if I have anything else left. Yes, I do. I just want to show you one last thing, which is not a big thing, but still I think it's interesting. I want to show you if the market cap, how big is the firm. You just Google the stock and you just see market cap, it's in billions. So it means it's a big size firm. It's a billion firm.